Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, December 3rd, 2023. It's a little bit in front of noon here on the East Coast. I'm Wayne, and I'm going to apologize in advance for probably some really sick sounding commentary because of this illness that just will not go away for me. So I'll apologize in advance for likely coughs and so on, but we'll get through it and I'll try to make it quick because of that reason. Anyway, here's our trusty disclaimer. Here is our trusty intellectual property rights notice. And then finally, this is this week's stream of really updates, right? Things that I'm just trying to make sure I include, and hopefully cover. I'll do the best I can. We'll go through this stuff. We'll start out at the top and then we'll move into the charts, but I think it's just I've been keeping the most likely scenario, kind of somewhat predictive stuff at a minimum, because I think this market phase has been very forceful. I think what we saw was really a perfect storm. We were talking about how there were signs before this happened, that there were signs that usually the market was rife with them in terms of what usually precedes relief rallies. This has been that and then some. And I think when you factor in that there was so much that made sense about the timing and how it's been handled. So the force of the move, the depth and effect of pausing that they've put together, haven't really given much back at all here and there. But yet they've held and then just kept going. The rally has broadened out. We saw that week after week, the last 3 weeks for sure. It's right in time with the seasonality, cyclicality, right, of the presidential election cycle, the time of the year, just the months, the way they unfold. December is usually a very good month on top of it. Next year tends to be very good, at least at the start of the year for the presidential election cycle. And so all these things, and you add in the fact that the dollar has gotten hit, yields have gotten smoked, and it's all set up. For it, we were set up for this, and it's not a shocker, right, that this has persisted, even though really you like to see, or you expect to see some brief and shallow pullbacks, but they've sort of been there a little bit here and there, but not so much as you would expect, maybe. But that's what happens sometimes during super bullish phases. So we can't really say much about last week, other than the outcome was that, look, the Qs and spiders paused, but the diamonds and IWM by the end of the week really roared. IWM was a focus name in one of our services, and I'll take the hit on that one, because I was pushing for it, because I really thought that it was lagging behind the other major index ETFs, and with the way that rates have been coming down, that they could bust it through. Unfortunately, it pretty much waited until the last moment on Friday to do something. So I hope folks still did well, but I was a little surprised it wasn't able to get going sooner, but that happens sometimes. Anyway, most sectors also look very good. And we've got to repeat this again, right? That the gang has handled this very well. They've been overbought extremely at times, and yet they've kept that bullish complexion in place. There's been very little give back. These consolidations we talked about are in the dust, and we're coming up on the second best year, in theory, of the 4-year presidential election cycle. So with all that, right, then what we can go talk about our other things, but I'll get through this probably a little more quickly and get back to the tabs. But I would say at DEFCON 3, there's a little bit of news that's out here, maybe a lot of news that's out. I just kind of caught it. I've been struggling this morning a little bit, and so we'll check that out in the tabs. That has to do with the supposedly the Pentagon confirming an attack on a U.S. warship vessels in the Red Sea. And to me, this is just more depressing news. That's I'm not even going to comment on it. It just seems very predictable. Let's put it that way. Very distressingly and depressingly predictable. But for now, right, I think you have to keep your eye on yields and the dollar still. And if they are still under pressure, you're going to maybe see some hesitations here and there, and so on and so forth. But without this news maybe shifting things, maybe it will. we've been saying that, right? We need a news shift to really to start coming back down. Why would you really start selling without some news shift? So there could be an instant reaction to this. 70 Cent, they're calling him now, him or her. That's the supposed VIX player that was huge for a few years, playing 50 Cent calls in massive size. And 70 Cent, they're saying, is due to inflation. But 70 Cent did appear this week, if that is the same player, with a rather large play in the VIX. And as we all know, the VIX is really just off multi-year lows recently. So we'll get into the rest of it now. I'll start bringing up some of the charts, but then tabs. So let's reposition things just a little bit. Just bear with me. Stop the share. And let me get over to these tabs right here. I think I'm going to pull this over to here. And so I can see what's going on. Come on. And then I can bring, it's giving me, I'm getting a little bit of fight here. My apologies. I'm getting a little bit of fight from moving PowerPoint like I often do. So let me get the share going again. My apologies. This should do it. Put me right on my main screen. So screen 3. So this is the news I'm referring to that's hitting Twitter. I'm not sure exactly when this was confirmed, but again, not what you want to see, unfortunately. But that appears to be at least sweeping Twitter. So I would assume that it's probably a legitimate report at the very least. That, in other words, legitimate in the fact that it happened. But let's cover the tabs, other tabs while we're here. This has been it, right? This just yields just continuing to drop. We've been talking about this now for nearly 2 years. And if you look at this, right, it's, this is why I stick with it. The market's basically been very inversely correlated to overall, right, to yields. And so here's where yields peaked out last year in October, started sliding, and we're coming off. And you can see, right, we all know that the market bottomed last year in October and pretty much rallied for really through July. And then when this started breaking out again, that's when the market came under pressure. And then this topped out, right, and in late Oct, and then the market bottomed out in late Oct. So just kind of gives you that idea, right? I'm not going to belabor that, but I don't know if it's over yet. It's just that we have to trade. We're trading in the short term, so I think you keep your eye on that and you just keep going with it. I don't think it's tick for tick, right? But I think you just got to keep your eye on that. And if you start seeing really big moves and the market higher in yields in the dollar, and you see that stocks are up really big and they're kind of ignoring it, and you've had a good run, right? That's the kind of information where you have to be ready to react with your final roll or whatever you're holding, right? Because if they do start, eventually those yields will probably get to things eventually, right? You just got to keep an eye on it and see if it starts to matter. And usually it will at some point, it'll come back. But look, the probabilities are pretty much almost a lock that we don't move in about 10 days from now. And you've got to jump out only now until the 20th of March, 2024, to see that the probabilities favor rates coming down at that point already. Again, this stuff's been pretty volatile. It's kind of been all over. We'll see. To me, it just still feels like, I think the Fed I kind of said it a few months ago. I thought, I'm not an interest rate expert, but I just thought that the Fed ought to go into this chill mode. I'm kind of glad that they have gone into this chill mode in terms of where they brought rates to. I think it was a wise move finally for a change to give it a little time and see where we are. And I don't know, right, if there's enough bad stuff that'll come out between really now and that March meeting that the Fed will see to suggest to them they need to really start cutting that quickly. But that's where the market has it. So, I would go with the market more than myself, to be honest. But it just strikes me as being overly optimistic about rate reductions. Here's the II sentiment that we check out normally every week. And you can see now, right? I said last week we were the highest since a critical point in the market in the summertime, and that's true again, right? We made new highs in bullishness. You're right near where the market peaked out at 49 in early August, and really that was shortly, I think, after the market had topped out. And you could see that your bearishness, you've got to go back a ways to find anything right less bearish, right? So there's nothing on this particular view right now that's less bearish. So to me, at this point, like, this is telling me that you really are due for a pullback. I really do think that you should have a pullback of just maybe 1 or 2, maybe 3% at the least. This has been an astounding, extraordinary move. It's, I think, one of the top 7 moves in the last 30 years for 1 month, from what I've read here and there. And you can just see that this is very stretched at this point. So so there you go. Pessimism reaches lowest level since 2018. So this is definitely overdone sentiment wise. We all know that's contrarian. So you got to keep that in mind. This is, far from perfect measure. We always discuss that, but it has come a long way. So what I would look at is, right, how this is really jammed from where it was. It's been a super quick shift back up. Not that it's unprecedented, but it's the same kind of super quick shift we've seen. Then it gets towards these upper levels, and then we kind of get the rollover effect afterwards. So just be on guard. You're not quite overdone. I don't know how much this news will shake things. I know that the awful banksters and a lot of these other corporatists are probably really loving this news as much as it makes the rest of us ill. They're loving it just that much, but it is what it is, right? It's sort of beyond our control. Anyway, the other thing you should note, I think, is that this overboughtness in terms of this measure, right? They've really jammed things. They're up there. Certainly, it can get a little more excessive, right? We know that, but I've always just said, look, if it's close, right? The market's more of a fuzzy logic place than an absolute black and white place. And so I would opt for that kind of interpretation where, look, it's pretty close. It doesn't have to go there every time, rather than, well, it's not quite extreme yet. It's extreme enough, right? And I'm not trying to sort of shoehorn a pullback into this. I'm just saying that that's my natural way to look at it. I just do think there should be a pullback, but again, calling for pullbacks and all these calls, and I fell into that trap when I first got started and had to work my way out of it. And if you're new and you just take it for what it's worth, just one guy's opinion that went through it, and that was the custom, right? Those were the conventions of technical analysis. That's the impression you were left after reading a lot of the material and the way that people handled that area in the market that published information or research or what have you. And so the whole idea that they put forth was that you need to use these tools and techniques to create to develop a forecast. And you think it should go here by then, and here's basically find a reason why. And that's fine if you like to do it. I'm not criticizing people that like to do it that way. But what I found is, for short-term trading, or just really better trading, trading that is nimble trading that's opportunistic, trading that allows you to be very dynamic. That type of mental approach that's required for that is not the one where you dig your heels in and stick to a forecast that you made, because the reality is that I think the markets are dynamic. New information comes in that does seem to have an effect at times. The market often does things that we expect ultimately, but in much different ways than we expected it to. So it's really all about the path that it takes sometimes to get there and how long that path takes to traverse or travel. So there's a lot that goes into it, but I think that I'm not trying to shoehorn a forecast. I'm just saying probabilistically, right? In other words, most likely scenario should be, in my mind, should be at this point, we should see at least a small pullback of 1% or 2%. And that could set them up, right, to kind of solidify things up in front of the Fed, run after the Fed the way they have tended to lately, finish the year just super fine, right? Looking good, getting big bonuses and the rest of it. But this is the final thing I think that I want to, well, no, actually it isn't. But this is something I just wanted to mention, that just keep an eye. You've seen this before if you watch this every week, but notice, right, that after you start finally seeing rate cuts in the immediate aftermath, the market's fine. But after a year, the market is typically down about 10% on average. Now, there's not a ton. You don't. It's not like you've got thousands of examples of this, right? But this is from the data that this gentleman, Nick Maggioli, apparently was able to, Ritholtz Wealth Management, was able to uncover. So when you look at that, this is what it basically comes out to right here with this nice little graphic. We haven't really gone back to this, but get the idea that, here's your 250 sessions. When you finally get towards a year, you'll see, right, where you really end up. So it's basically a pretty deep dip depending on what you look at. So remember, if they do start to cut rates in the spring, or maybe late spring, maybe, who knows, that is really a time where the run may have already happened traditionally or historically. So just keep that in mind. Okay, so that is that. Now let's get into the charts a little bit, and I'm going to bring this one up. And so the main thing I'm going to show here is that, this idea of pausing, and I don't want to belabor this, like people that have been at Market Rebellion for a long time. There's a lot of things I say over and over again because I think they're just very, very valuable, and it gets you away from looking at things in a conventional way. And what I've learned, which was different than the impression I had after doing my initial work and research and technical analysis. What I've learned is that something like what we saw, where they paused the market in the SPY, and they remember, they got the market up to about 455. They did that on 1120. Okay, and this thing pretty much stayed there all the way until you closed at 456.40, all the way until 1130. So for 10 calendar days, you were effectively sideways. And that is what I just call a pause. I mean, it's nothing clever, right? Or probably used by a lot of other people. But I would say that when you're in these very strong phases, for a lot of the reasons, poor positioning I neglected to mention earlier, all kinds of things, people off sides, whatever you want to call it, this is just as good as a pullback. And that's the thing. I look for pullbacks. I did note last week that there could be some trouble because we were maybe falling under a support line, but the 10-day wouldn't probably matter, and it did, right? Like we said, if they can't hold the 10-day, this thing's probably going to get rocked for a little bit more. They do. They might just be able to hold it and eventually go. And that's what they were able to do. And so after they kind of did a hold here for several sessions after that initial burst, right, you kind of need to treat this as, well, that's all I'm getting. And the reason for that is because, and this is why this game can be hard, is that you have to realize that you're in potentially a very strong phase. It's something different. Like you made this very strong move from really a market that was rife to deliver a strong move. They got it above that 50 there in gold in the SPY back then. And then this thing just keeps going. And there's room. And we even said it, I think, that, you can't rule. I think pretty much in here, excuse me, we were saying that don't rule out an attempt to get back here. And they've already exceeded that. So how can you rule out, excuse me, I'm just struggling with this issue. So how can you rule out more, right? All they really have to do, if you look at it, those highs were eclipsed. Now, I do think a pullback is due. So please don't interpret this as me saying, oh, this thing's going. But you can see there's patterns here that are favorable patterns. You have an incoming uptrend. You have a correction of the uptrend. It holds the low by far here, and then they start uptrending again, right? So it's the resumption of the trend potentially. So we have to say that's possible. At the very least, even if you're like me and you're more of an economic bear that finds this very overly optimistic, right? The way the market's acting. We don't trade it that way, but that's how I look at it on an economic side. To me, you have to acknowledge that you could be wrong. about that. My take could be wrong. They pulled it off before where I've been sort of right about the economy and it didn't matter too. Excuse me. And you don't know what news is coming out, whereas Wall Street likely does. So you really don't know everything they know. And if you start thinking about it those ways, like that's the reason why you really are almost forced to go with or either make adjustments and kind of like turtle up, or you're kind of forced to go with it at the very least if you want to profit. But if you don't lose, right? If they're if they're doing their thing, don't lose. But uptrend consolidation, they're working out of it. We said well, they're breaking out, and we said they could maybe come back and do this. And I thought it would take more like to the mid of October. I'm sorry, mid of December, excuse me, at the very least. But they're doing it now. It just shows you, even if you have a good idea of what might happen, that sometimes you're still going to be surprised by it. That hey, they were able to get up to where I thought they might be able to get out and take out this high. It happened faster than I thought. And now what's left? Only the all-time highs are left. And if you look at this, which I'm going to try to show us here, which is why I'm on here, if I show you kind of like the fib extension, the basic fib extension, that puts you right near the all-time highs, right? So the next level up, if they're able to sort of pull back and then get going again, the next level up's the next big test will be up there. So that would really be my kind of like initial, like realistic target, right? Where do you think this, people say, where do you think this thing can get to? Well, I think it can get to there. Doesn't mean I don't think it can get higher. And I don't mean to the penny. I'm just saying in general, in a very basic way, this is where I think it can get to, towards these all-time highs. And then we see what happens when we get there, right? This is the kind of iterative charting thing that Ryan and I always did, because we found it, once we figured things out about it, we found out that what this does for us is it leads to better trading, better position management, right? The kind of thinking in these terms and operating under like, I'm going to do my best to stick and move with this as it unfolds, because I really, right, I can have all the wonderful theories of this, that, and the other guy or gal in terms of technical analysis or whatever you want to bring into it, astrology, anything you want, numerology. There's so many things people use, and that's fine. But ultimately, if you're dealing in the short term, especially, you've got to keep track. You've got to account for things in the here and now. And this kind of like iterative, open-minded approach, I think is the best way I've found, put it that way. So on the flip side, where do you think it can pull back to, right? That would be another question people have. And I think really, believe it or not, this gapish area near about 380s on the high, roughly 380 roughly, that is about where I think it can pull back to in terms of, and that's not a big deal. That's 2.5%, just a little over 2%. That it could come back to there. I think there's definitely a flat line, like, really right near there as well, if you look back over time. So those, I'm just covering the big ones, right? Because these are the ones that people have questions about. So that's where I think this can get to. And let's face it, right? They've already put this extremely powerful move together, and brought a lot along with it. And what I mean by that is this, right? If you look at this board, and we'll talk about it in sector situation, if they don't hospitalize me first, but nearly every sector that we have on our grid of 12 has been brought along to some extent. And even energy, which I've been saying, like, it's starting to show a little tiny bit, a little something. It's probably early to hang our hat on it, but it's starting to show us a little bit, just simply by the fact that it's not worsening up here in XLE. So I don't want to belabor any of that, but the point is, right, that they brought a lot for the ride. Now, what I would say is the most likely scenario, even though I'm not trying to really dish this out, my most likely scenario would be that you do finally see a pullback. If you look at some things like, let me do this. I'll just do it from here. I was going to do it on my other software, but I'll just do it from here. So right now, here's IWM. And again, I hope people were patient and caught that move, because I was thinking we could really go finally. And I was feeling bad about that all week long until Friday. And I hope people didn't quit for the week. But right now, I can't do that. I got to do it the other way. My bad. Oh, my apologies. So IWM, I've got that checking in at a cool, crisp 73 RSI reading on the 4 hour and a 77 RSI reading on the 2 hour. Now, sure, I have seen worse readings, but right, that's overdone in the short run. I mean, it just is. And so I'm not saying, again, this does not mean it cannot keep going. I'm just saying you got to appreciate where you are. And right now, if you enter here and it keeps going, that's fine. It's just that I would have a very kind of low tolerance for um, giving back profits. I wouldn't be willing to give very much back and be super patient with it. It would require probably the dollar and yields to be getting crushed again and everything to be screaming for me to not really be worried, right? If it's doing it on its own a little bit more and you see the other things under pressure and the dollar and yields are moving up, yeah, I would be very like 1 foot out the door. I bought 20 calls. I just sold I just sold 10 of them. I've got some nice profits. I'm really going to roll the rest and see what happens and be careful with how I handle this at this juncture. But probably the most egregious situation right now is here in the diamonds with what they did in the final 2 days of the week. So you have a daily RSI reading of 80, period. I mean, you just don't see the RSI get that much higher on something like this on the daily for very long. So that just again is telling you, I think, right, exactly where you've been in terms of let me see here, my bad. Let me get this let's see if I can get KSS, which is it brings up the technicals that I want here. My bad. And then what I'm going to try to do is just show where we are here in diamonds. Oh no, what did I just do? What happened to my RSI? I bring this back up. It just dumped it. Where did it move it to? Why did that happen anyway? What did I do? All right. Let me see if I can do that again. And I don't know why that did that, but that's sort of annoying to me that it did that. Now, you know what? I may have to come back into here and see if it'll reload from here and it might give me the right one. No, it doesn't, or does it? Okay, it's giving me the colors that I like. Now, sorry about that, everybody, but yeah, something weird happened there. But let me get to diamonds now. I don't know what I did on that to trigger that, but here's the point: is that I'm going to mouse over this RSI reading, and to get a diamonds reading of 80, we have to go back to 2018. Okay, and that's right there. So let me just give you that visual on that one. To get anything more ridiculous than they made it here this time around, you've got to go back to here. Okay, that's the one right there, right around there. So again, that was after this kind of like late year relentlessness that followed in early into the next year. Kind of like what I'm thinking is probably right with it, again, in the absence of news, the most likely scenario is probably that. But you could see, right, that after the difference between this reading and this reading, right, is just that this is even more of an insane run and tacked on to an insane run, right? So that's why this one is obviously worse, even though it's similar. But you don't really see these that often, other than right when they're doing a lot of their shenanigans with this was QE hyper madness and QE to infinity, QE to this, that, whatever, probably. Like I can't even remember. It just all I remember from 2009 until recently is QE. It just, everything, just buoy everything, keep everything just tacked up. Anyway, so you get the idea. This is not normal, right? This kind of a level that we're at is very, very extreme in terms of RSI. Now, I don't hang my hat on RSI, and that's all I need to see. I'm just trying to bring perspective. That's all I'm trying to do. And this is a very, very extreme move. So that's, if you look at that kind of visual there, yes, there are other similar, right, kind of ramp jobs. But of all these that were really strong, sharp moves, this might be the sharpest and quickest of them all, depending on, in terms of the initial burst. It's very similar to a couple others, though. So we'll say that. See, at least in that class, that category. So you got to be careful here. I think you have to remain nimble. So I don't want to belabor all this, but that is that is where I'm coming from with this. So let's see if I can bring this over now, and we'll cover some of these other points. So we covered all of our tabs, and it moved on me. My bad. So we covered all of our tabs. We did say stick at 3.0. In other words, be ready to be ready, in terms of DEF CON, because you can't, when you get like this, you just can't sleep on it. We talked about 70 cent. Again, I still have it in here. I still think a pullback is needed to be able to pave the way for, what they think is their birthright rally that they call the Santa rally that starts, really, I think later in mid to late December, when Santa, is supposedly getting ready and is on his way. And so they're going to need, I think, to do this to pull things back down a little bit to really set that up. And it's due. So, and maybe it allows the squeeze in the 24 to keep going. The wall of worry, despite what they're selling all over Twitter and all the bubble vision and all the rest of it, I'm hoping, again, to be wrong about all this and my concerns, that is. But I think, they're still ahead of themselves. I think that there's no way that things are anywhere near as rosy as they're putting out. I might be wrong about other things coming down the pipe that I'm unaware of in terms of political developments or policy developments or this or that. But I don't think that what they're telling me is the truth. Unfortunately, I just don't see it. I don't even want to go into all the other tabs I could share, because that's what really extends this into madness, into the depths of madness in terms of how much time we spend. But there's a lot of things just that are out there that just tell you, well, this has actually been a very good historical indicator, and it's not impressed with what the bulls are pushing in terms of their macro takes and how all this is going to be a soft landing. And it's only natural for them to push the soft landing. They always push the soft landing. I mean, I'll be happy to enjoy a soft landing before I check out. But I don't remember when I've ever had the soft landing that they've promised me. But anyway, the Qs are in the best shape of all, though, in terms of like what we talked about with diamonds and spiders being over. Certainly diamonds overdone, spiders overdone in the short term, more so, not the bigger picture. But spies and Qs, they look the best. Both Qs looking the best in terms of RSI. So believe it or not, right, the leader of the pack, so to speak, if they're going to want to goose things again, that's already in the best shape for them to start running things. So you might want to keep that in mind, because we have seen rotation. EOA's been on fire. There's been a lot of things that are they're perking up here and there. So, and that's good. That's what we expect during a month like we just saw, to get really good UOA hits. That's what we expect. So I'm glad that really started picking up, because it was kind of I was a little surprised at how maybe things were a little more subdued than I expected in October. But FOMC 10 days away. I think they're going to try to feast on the same things they have been, which is just the uncertainty and all that. There's more slowing. There's more of that kind of, I think, bad stuff on the way out in terms of news that it's just not going to confirm anything anytime soon myself. But that could start to shift things ultimately. But I think, again, I'd watch your yields. I'd watch your dollar. And as long as those things are well at bay, I think they're going to keep trying to move this market up. I did talk about the next realistic target being the all-time high, pretty much the Qs. I think the Qs are going to be 400, then the all-time high. Right now, the SPYs are basically the all-time high since you're through. I also would note that, again, this news about the Red Sea is possibly the game changer in the short run, maybe the long run, for all we know. But the XLE is trying to slowly work it through. The precious metals are flashing, and rate expectations have had a massive shift, as we saw. So these are all things, right, that are interesting, that are, I think, worth noting, because there's a massive pattern. We've talked about it in a sector situation, and the metals jamming could be a really big story. And if XLE starts joining the party, that would start making me feel a little bit better about the economic recovery that I'm supposed to be buying into right now. Because I just haven't seen that move. It's been a very disappointing space for a lot of bulls. And I feel, again, fortunate that we were not really beating, like pounding the table in there, too much on that, because there's been a lot of talk about that, but it's been, I thought, technically challenged in some ways for a while, but it's starting to get close to working that out still. So it's hinting at it, but not there yet. Still, I would still be proactively reactive. I mean, just, you got to appreciate where you are. Hopefully after watching this, that they got their stabilization and then some in November, right? And now they're still, I think, overlooking a lot, like I said, but I think they're set up, unless this news changes things, for a pullback and then kind of finish the year the way that they typically do, without really that news dynamic shifting in a big way. I think that they're set to do their thing. So there is a little concern, though. People are getting very concerned. I'm sorry, people are getting very one-sided. We talked about that. The sentiment shows that right now, how few bears there are and how many bulls there are. And people are going crazy buying call options and not even addressing puts. So keep that in mind, because that does usually happen right in front of extreme highs, the way we could be seeing here for the short run at the least. So these, as we noted, are definitely a problem in terms of due to the last week's burst in the short run. Certainly in IWM, it's more of a short run indicator, but diamonds are just, as you saw, they're multi-year absurd right now. So these are recent important thoughts or considerations, is that, as much as you hear me say now that I've been concerned about the economy for a long time, and I think a lot of these statistics are tortured statistics, and I don't buy a lot of what they sell us. But then it's been that way really just since I got into the business. I feel like it's always been proven later that they were playing games, but people really don't care about that. It's just the way of the world these days, I guess, and has been maybe for a long time. But you hear that, and I just don't want everyone to think that I'm really trying to push this bear stuff, because I don't believe in that in terms of short-term or active trading. I just think it's important to know about risks. I think you've got to know that there really are risks out there, and I think that given how awful things were for so many stocks, look at the IWM until recently, for example, right? This has been more of a concentrated rally in certain areas for the most part, and a lot of damage is really done under the surface. But that is the paradoxical thing where, they were able to do what they did, mask that kind of weakness very well, ignore a lot of things, which they do, and keep things looking good. And so with that in mind, they could really be on the verge of a new bull market, because there was so much. The last couple of years have been really rough for so many companies, and so on and so forth. So don't think that can't happen, is my point. I'm not saying it will. I'm just saying don't think that it could. I still think there could be a trap. I still think, right, oil's looking a little better, like we said, the last couple of weeks, but it really hasn't jammed up there. And just don't buy into that either. If they start telling you that, hey, this is wonderful, we keep rallying, that's great, we can all do well, we all want to see that, but right, you just got to keep going back and saying, but is it really happening? And for me right now, I just don't see it yet. Now, it could be on the way, it really could, but I just don't see it yet. I still see things that are very concerning to me. So again, I think it's a tricky time, especially with all that geopolitical news out there. Very tricky. So I think you have to really be on your toes here. Don't let your guard down. It's easy to get distracted during the holiday season. Everyone gets busy. Keep your nose to the grindstone. Don't let them take your really good work that you've maybe done this year or this quarter and get sloppy with it and give a lot back before the end of the year, right? That's just not something you want to do. Not with the kind of risk that's out there right now in this world. There's just too much floating around out there. So let's take a look at our final thing would be, let's see if we can just come up with IWM. I'll try to put out a couple levels on this in terms of maybe if you are looking at this, like what's likely to be next. And really, to me, that's your flat line right there. I think you have to look at that and just say one about 189, right? So one more, if they sort of shrug this off, 189 to me is, it's certainly doable within a week, but I think that's your next big level. Up there is about 180. Yeah, about roughly 189 to me is really your next big level. So what is that about? I guess that's about 2%. So it's got 2% more to me before it sort of has a real struggle to do anything. And it could get a little bit more. You can see that does get a little higher at times on RSI. So it's not like this would be unprecedented. If they somehow manage to shrug off the Red Sea news like it's nothing, maybe they will. Then let's just take a look at the diamonds, and then we'll wrap up since we talked about the spies and the Qs already. But this one, right? This one's obviously a little bit harder because of how absurd they've got it right now. But again, they might start buying a few of the big name industrials in here based on this news. I don't know. Maybe we'll see. But look, that there is, you really can't rule that out. So that would be, again, another 2%. So I think another 2% on both of those to the upside is your level you're looking at. As far as the downside goes, probably going to have to go with 355, right? So that would be about, well, that's almost 2% to the downside, right? So I think that's probably you've got a flat-ish, right? 355, 356. So there's that. I don't remember if I gave that out, so I'll double check it on the IWM. As far as IWM pulling back, I think you can see, like on these charts, we're trying to make all of our charts kind of line up color wise for people. And right there, the 20 is the 176 level in IWM. So, that would be a multi-percent pullback, and the 50 is 173. But really, the red one there in the middle, that is your 100-day, and that's at 181. So I think between there being a flat line at 181 and the 100-day being at 181, on your downside there, that is your next probably a first stop, right? Of where do you think you get to first? And then if you're in the services and you need some other levels on these during the week, just please inquire in the forum. But I think really, it's time to keep our eye on the ball and just keep our focus and just be nimble in this stuff, and not, you're at an extreme overbought area in these two in particular we covered here at the end. The other ones are more primed to go if they want to, but probably the whole thing needs a pullback first, and then that would maybe set them up for their dream end of the year again, birthright Santa rally that they really talk about way too much. So I'm trying to think if there's anything else, but I think that is it for now. So I think I'm going to end on that. And what I mean by protracted trap is that, right, this people thought a lot of people were like in my camp thinking things are really going to slow. So they probably got a lot of bears trapped in what we saw from July through really the end of October nearly. Just like they could have bulls trapped before that were going hog wild in the spring and just running. They might have bulls trapped again, right? If we get into, let's say, April, May, and no rate cuts have happened, and they're still talking about leaving rates up there, right? And then that ultimately that effect could be very stagnating because of high prices combined with high interest rates and the inflation we've already experienced. It makes it affordability of major ticket purchases a big problem for people. And clearly, I think I saw something that said that housing maybe had one of the plunge in housing is one of the, from the new home prices, is one of the highest that it's been, I want to say, in history from the highs. So the home prices are in some ways crashing in a massive way. A lot of people say, "Oh, it's not happening near me." I'm not sure that's the way you want to look at that. I mean, it's, certain areas are just get very hot, and they're kind of resistant to that, right? But overall new home prices are crashing at a record pace in terms of where they were to where they are now. So that I think things have been stagnating for cars because I think used car prices are coming down to an extent. I think it's just a saturation effect of too high of prices, too high of debt for too long. Income's not keeping up. Um, it's just a rough combo. So I don't know how that it all ends again very smoothly. Hopefully I'm dead wrong, but I just think bulls might again be getting ahead of themselves. So you really could have a situation where a lot of people are just depending on their timing, just trapped on the wrong side or get themselves trapped on the wrong side with what we're seeing now and what we still may see in 2024. So I hope something I shared with you helps you out this week. It's been another rough one for me in terms of trying to get through this. So I'm sorry about that, but hopefully I won't have to say that too much longer. Hopefully these antibiotics and stuff are going to start turning the tide a little bit more for me. So I'll wish everybody a great conclusion to their weekend and a great and hopefully nimble trading week ahead. And like I said, I hope something I share with you helps you out this week or in the future. Thanks for tuning in.